Hi guys, I hope you're doing well. This is Luqman Rafiq here. The objective of this video is to discuss about the current issues that may become part and parcel of the SBR course. Now, before I go on discussing the current issues, let me just give you a bit of a guidance that what are the things that could be included in the current issues. So there are specific topics that the examiner has identified which may actually be tested as part and parcel of the current issues. There could be a lot of situations where the current issues are examined, but you as a student don't even know that the current issues have been examined. So like maybe possible to us, it might seem to be a normal accounting, but it is actually part and parcel of the current issues. Now to help you understand what a current issue is, let's just try to understand. The current issue could be multiple things. One of them is the current issue could be that how the present circumstances, how they are developing and how they could have an impact on an entity's financial statement. That could be the current issue. The second thing could be the proposed development to the IFRS. The third thing could be the new things that are developing up in the market, like the digital currency, the cryptocurrencies and all that. And fourth thing is that the exposure drafts that are being published by the IASB. So the current issues could actually include a lot of things. Now, as a student, a lot of students, they get worried that we have not covered up current issues or we are not very much confident with the current issues. So let me just give you a bit of a guidance that even if you are not very much comfortable with the current issues, just remember this thing: you need 50 marks for passing. If the current issues are being tested for 10 marks, and God forbid that you are not being able to handle the current issues for those 10 marks, that means that you will be getting marked out of 90. Now, all that you have to do is that you have to make sure that you get whatever you attempt, you get that 75% correct. So like for example, you say that you have missed out 10% of the paper and you don't know about the remaining 10%. So there is still 80% paper that you will be able to attempt. And if you attempt that paper 70% correctly, so you'll still end up getting the 56 marks. So my suggestion to people is going to be that when you are attempting the exam, don't just panic. All that you have to do is that you got to make sure that you do attempt whatever that you attempt to the best of your capabilities. And a lot of tutors, they would say that attempt everything, attempt the whole paper. I may not agree with that. I believe that even if you attempt, if you miss out some parts of the paper, but you attempt the rest of the parts correctly, you can still pass the paper. But what I will do in this upcoming video, and there's going to be a series of videos probably, I will be discussing about the current issues in detail, that what are the different type of current issues and what are the factors that you got to keep in mind when dealing with these current issues. So the first one of them that I'm actually going to be dealing through is the climate related disclosures and the investor focus. Now, let me just give you a bit of an idea that what is this climate related focus and what is this investor climate related disclosure and investor focus. You would realize this thing that over a period of time recently, there have been a lot of developments across the globe. And those developments, what they have done is that they have actually focused upon the entities controlling their environmental impact. Now, what could be the different type of things that the entities they do in order to control their environmental impacts? The activities that the organizations that do with respect to the controlling of the environmental impact is that like maybe possible, let's say we are reducing the CO2 emissions. We are actually going for the alternative energy. We are going for latest technology, or we are actually going for the environment friendly activities, etc., etc. So let me just give you a bit of an idea that over a period of time, what is actually happening is that there are a lot of change that are being taking place, and they're having an impact upon the entity. They're having an impact upon the companies. They're having an impact upon individuals. They're having an impact upon the investors. So if you think from the perspective of the investor, if I'm an investor, if I'm investing into the company, so I would actually be interested in knowing that how are the climatic change going to have an impact upon the entity? What are the things that is going to happen with respect to the business model, with respect to the strategy, with respect to the overall risk that the organization actually faces, what are going to be the impact on them. So as an investor, I would actually be interested in that. Furthermore, what has happened is that over a period of time, a lot of companies, they've gone on for the voluntary disclosures pertaining to their contributions towards the preservation of climate, their contributions towards ensuring that the climatic change does not have a very big adverse impact. So the companies, what they have done is over a period of time, they have actually started giving the voluntary disclosure. So now, as an investor, you need to know, as an accountant, you need to know, as a stakeholder, you need to know that what are the actual impacts of the climate on the entity and how exactly is this entity going to address them. So here you have this technical article, and in this technical article, it has actually mentioned about the information that the investors may require with respect to the climatic change. So one of them is the investor would be interested in having or getting to know about the strategy for assessing and considering climatic change, that how the entity is going to address the climatic change. The second thing is that what matrices. Matrices actually means the performance measures that the entity is going to use in order to measure the climatic change. Plus, furthermore, what are the opportunities that would arise to the entity if this climatic change would have an impact on its operations, and what are the risks that it is going to be facing. Plus, what could be the impact on its profitability, on its assets, on its cash flows, etc. Plus the company's viability over the longer term, etc., etc. These are the things that the investor would be interested in. Just think about it. If you are actually if you have invested in a company which is manufacturing a product which is not considered to be a very environmental friendly, like a company which is manufacturing diesel engines. Diesel is not an environmental friendly item, but unfortunately, because of the load that the diesel vehicles could sustain, or because of the distance that they could travel, or because of the different benefits that the diesel engines have, the diesel engines are not being discontinued. But it has to be agreed that the diesel extracts are not environmental friendly. So if you have invested in a company which is manufacturing diesel trucks, so it may actually become a problematic situation for you as an investor in the longer run, in case if there are bans on the diesel engines in your country, or in the countries where you export, or in the countries from where you actually import the CKD units. There could be many things that could actually have an impact. So as an investor, you would be interested in knowing the impact that this could have on the company and ultimately on the financial statement. Here we have got multiple accounting standards and the impact that have been discussed pertaining to the climatic changes. So now there is this one thing which is about IAS 1 presentation of financial statement. You know, IAS 1 actually tells you how the income statement is going to be prepared, how the balance sheet is going to be prepared, how the statement of changes in equity is going to be prepared, and what notes to the accounts are going to be prepared, what disclosure notes are to be provided, etc., etc. All of these things have been provided by the IAS 1. So I repeat, all of these things are actually provided by IAS 1. Now, with respect to the IAS 1, there is something that you need to understand, which is IAS 1 encourages entities to disclose the material information which could have an impact on the entity's performance. So in case if there is a climatic change, if there is a climate related matters which could require an entity to give the disclosures, so IAS 1 would require that the entity give those material disclosures in its financial statements. That's one thing that you got to keep in mind. Now, the second thing is that whatever the judgments, whatever the things that you have actually evaluated with respect to that climatic impact, you got to disclose. Furthermore, if that climatic change could have an impact on the going concern status of the entity, if that climatic change could have an impact on the going concern status of the entity, so you got to give a disclosure also. So you got to keep in mind that the IAS 1 major thing that would be the climate related change could have an impact is the disclosures that would be impacted because of IAS 1. So in case if you come across an exam question where there are environmental changes, where there are regulatory changes which pertain to preserving of the environment, which pertains to preserving of the climate, so what you need to do is that you need to talk about the entity is required to give the disclosures if this has a material impact on the entity. The second thing is actually about the inventory. At times what happens is that your products may actually be discontinued. So your products may actually be discontinued, or there may actually be taxes imposed on selling those products. So if there are taxes imposed on selling the products, or your products may be discontinued, so ultimately it could have an impact on the NRV of the entity's inventory. So you also need to consider that if the climate has any adverse impact on the NRV. The next thing is about IS 12 income taxes. We do have the deferred tax asset on the unused tax losses. On the unused tax losses. Now, at times what happens is that you may have the projects which are going to be profitable in the future, but if their operations could be impacted by the climatic change or because of the regulatory change to preserve the climate. So ultimately what happens is that the deferred tax asset which you are recognizing right now may not remain the same, because you know this thing that the deferred tax asset has to be recognized on unused tax losses. I repeat, you need to recognize this thing that the deferred tax asset has to be recognized on the unused tax losses, which are going to be offsetted in the future periods. But in case if those unused tax losses are not going to be offsetted in the future periods, then that means that you cannot recognize it. So that is also something that you would have to keep in mind. The next is about the IS 16 property, plant and equipment. Now you see what happens is that there are multiple things with respect to IS 16, the residual value of the asset, the useful life of the asset. Plus, if you could just add up IS 36, which could actually be the impairment of asset, because ultimately it's the non-current asset that's being measured. So in case if you are using a non-current asset, and if there is a change, let's say that the company manufactures diesel engine and there is a change in the regulations which says that these diesel engines need to be discontinued in the 2 years. So that means the machinery which is being used for manufacture of the diesel engines may only last for 2 years, and its residual value may not remain the same what it is right now. So ultimately it would have an impact on the residual value. It would have an impact on the useful life. There are going to be multiple things. Plus, there is going to be an assessment of impairment, because that's an external condition, which is the external legislative condition. So you got to consider that also. So now, from the perspective of the exam, you got to think just that what are the climatic change that is taking place and how it could have an impact on the entity. At times, there could be new rules and regulations which could actually set out targets for the organizations to meet with respect to the climate, with respect to the environmental costs. So as an organization, you got to see that to what extent your environmental provisions, to what extent the climatic targets not being met could lead to the obligations, could lead to the liabilities. So you got to recognize the provisions for them also. Then we have got the financial instruments. For example, if you have extended loan to an entity which is going to be adversely impacted by this climatic change, or which would have an adverse impact on the climatic change. So ultimately what happens is that they may not be able to pay off their debts. So resultingly, the expected credit losses on those debts are going to increase. And if the expected credit losses on those debts are going to increase, so ultimately what is going to happen is that this could lead to the impairment of the financial asset. So you got to keep this thing in mind also. Plus, what happens is that there could be further things, which is that the climate change may reduce probability of a hedge forecast transaction. At times when we talk about the cash flow hedge, we talk about the highly probable future forecast transaction. So in case if there is a climatic change which could have an adverse impact on the entity's operation or the entity's ability to operate, so ultimately the highly probable future forecast transaction may not be taking place. So if that transaction may not take place, the hedge accounting rules may not apply. And if the hedge accounting rules may not apply, you may not be able to account for it in the way you are going to be accounting for it in case if hedge accounting rules are going to be applicable. Lastly, the another thing which is discussed is about the fair value measurement. So when we talk about the fair value measurement, just realize this thing, that when you are estimating the fair value, you're estimating the fair value, the factors which could have an impact on the fair value due to the climatic change, due to the climatic factors could all ultimately have an impact on the fair value measurement. So you got to make sure that while estimating the fair value, you are accounting for the climatic change, the impact that the climatic change is going to have on the continuity of the business, on the cash flows of the business, on the residual values of the business, on the market values of the business, etc., etc. All of this need to be accounted for. So basically, whatever that I've discussed in here, you would realize this thing, that all of these things are something that you just have to put an extra thinking cap on. It's nothing out of the box. It's nothing extraordinary. It's something that you got to understand, that in case if there is a climatic change and if an entity is doing the accounting, how can it impact the entity? What areas could it impact? What extent it is going to have an impact on the PPE valuation? To what extent it is going to have an impact on the disclosure, the fair values, the financial asset, the deferred tax? So all that you have to do is that you just have to keep the whole normal accounting in mind and just think about that what could be the impact of the adverse climatic regulations which are going to be applicable on the entity, what type of assets, what type of liabilities, what type of valuations, what type of the accountings are going to be impacted. So that is all about this first article, which is about the climatic change and the impact on the accounting and the impact on disclosures.